All right, welcome back, everyone. Last time, we dove into all the reasons why finance is just one of the absolute toughest battlegrounds for machine learning. We saw the pitfalls, the traps, the reasons why so many people fail.
Yeah, the big lesson was that you can't just grab some off-the-shelf algorithm and expect it to magically print money in the markets. The signal-to-noise ratio is just brutally low. But today we flipped the script. Now we're going to talk about where the real power is and how we can actually find an edge.
Okay, let's just cut right to it. That's the billion-dollar question, isn't it? After all the warnings and all the hype you hear about AI every single day, can these algorithms really give us a sustainable advantage?
Exactly. And the answer requires us to look past all that hype. See, machine learning isn't a crystal ball. It's a toolbox, a seriously powerful one, mind you, that lets us find insights and data that were pretty much impossible to see before.
You know, old-school financial models, they love straight lines. They assume A causes B in a predictable, linear way. The market just doesn't work like that. The real world is messy, it's non-linear. And that's where ML shines. It's designed to handle that complexity, to analyze messy, unstructured data like news articles. And maybe most importantly, it has built-in mechanisms to fight our number one enemy, overfitting.
So, let's get down to basics. What even is financial machine learning? It sounds super intimidating, but I promise the core idea is actually pretty simple and elegant.
Okay, here's the formal definition from the course. Now, the first part is what you'd expect, right? Learns complex patterns. But the golden phrase, the absolute game changer, is at the end, without being specifically directed. Think about that. We're not telling the machine what to look for. We're letting the data speak for itself.
You want to see what that looks like? Check this out. On the left, you have this massive correlation matrix. It honestly just looks like TV static, right? Pure noise. But then you unleash a clustering algorithm on it, and bam, look at the right. All of a sudden you see structure. The machine discovered 3 distinct groups of assets hiding in all that chaos. It found order where we could only see noise.
Or here's another classic example that makes it really clear. When trying to predict who survived the Titanic, we didn't tell the algorithm, hey, gender is probably the most important thing. Nope. We just gave it all the passenger data. The algorithm itself figured out the hierarchy. It learned that being female was the single biggest predictor of survival. Then it was about what class your ticket was, and only then did your age come into play. That's discovery.
Okay, I think I get it now. It's not about programming rules. It's about letting the machine find the hidden rules for us. But enough with the theory. What does this new toolbox actually look like when we point it at the stock market? Let's see it in action.
Whoa, hang on a second. Are you telling me that a machine read thousands of news articles about Tesla every single day and then decided if the tone was positive or negative? That's just insane. We're talking about a whole dimension of information that goes way beyond price. This has to be the future. This is the edge for 2026.
Exactly. And here's where it gets incredibly practical for any trader. This technique is called meta-labeling. It answers one of the hardest questions in trading. It's not just when to trade, but how much to bet. So you have your primary model that gives you a buy or sell signal. Meta-labeling adds a second ML model on top that looks at how confident the first model is, and then it tells you the optimal size for your bet. It's like adding a risk manager to your strategy.
And it completely changes how we build portfolios. On the left, that tangled web is the classic mean variance optimization. It's famous for being incredibly unstable. You change one tiny input and the whole thing can just blow up. But on the right, that's a portfolio built using a hierarchical ML algorithm. Look how clean and logical it is. It understands the true structure of the market, creating a portfolio that is way more robust and intuitive.
Okay, this is all really impressive for making existing things better and more stable. But let's ask the ultimate question, the holy grail. Can any of this technology predict something truly out of the blue? Can it actually see a black swan event like a flash crash coming?
You know, that's a fantastic question. And the answer is really nuanced. It can't predict the random event itself. That's what makes it a black swan. But, and this is a huge but, it can detect the insane pressure building up in the system right before the dam breaks. Look at this chart. This is a metric called VPIN. In the hours leading up to the massive 2010 flash crash, you can see it go completely vertical. The algorithm was screaming that a dangerous order imbalance was happening right before the market fell apart.
It saw the cracks forming in the foundation. But how? What is it actually seeing?
Well, it comes back to this brilliant quote from the author of the course. The VPIN algorithm isn't just some random black box.
It's built on a solid theory of market microstructure. The theory that big, informed players hide their huge trades by chopping them into tiny pieces. VPIN is designed to detect when there's a flood of these informed orders, all going in one direction. So the machine learning didn't just give us a signal, it helped us develop and test a powerful theory about how the market really works. That's the key, using ML to understand the why.
Wow. Okay, this is incredible. And with AI becoming more and more accessible, this really does feel like the path for how retail quants can actually compete. So for someone starting today, looking at all this, where do we even begin? What's the action plan?
Great question. Let's boil it down to 3 concrete steps. First, start with meta-labeling. You don't have to throw out your current trading strategy. Use machine learning to make it smarter by helping you size your bets. Second, embrace unstructured data. The easy money from just looking at price charts is long gone. Your edge now is in news, in company filings, in satellite imagery, data that others aren't using. And third, and this is the most important one, build theories, not black boxes. Use these tools to become a scientist of the markets. Understand the why behind the signal.
And that's a look at the real-world power of financial ML. Make sure you join us next week as we tackle Lecture 3. We're going to break down the most critical, foundational step in this whole process: how to properly process and label financial data. Trust me, it's where most people go wrong, and you are not going to want to miss it.